Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a senior manager here at Schwab, and this is long verticals and diagonals. And today I thought we'd take a direct approach at managing the back end of a trade, having a plan right up front for when to take potentially early profits on a vertical spread. Should be an interesting discussion. We're going to be planning and placing an entry order plus an exit order to get out at a predetermined target level if we can get there. We're going to get into the details of that in just a moment. We're also going to be managing existing positions in our paper money portfolio. Lots to talk about. But before we can get into any of that, let me first of all say hello to everybody out there in YouTube. Great to see Mighty Mouse Joe. Midway, hello there, right around the corner from us. JB52, Janelle, Life in the Fast Lane, Dragon Rider, Will, Scott, Christopher, Greg, everybody else, thanks for joining us week after week. We really do appreciate your attendance and your contributions to these discussions. If you're here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the fact, enjoy the presentation, but be aware that you're invited to join us in the live discussion. If you'd like to be here, it's a Thursday webcast series, and this one kicks off promptly at 11 Eastern time. We'd love to have you here in our live stream audience. And I also want to let everybody know that my very good friend Connie Hill is going to be hanging out in the chats with us. Connie is going to be addressing any questions that I can't get to during the flow of the presentation, as long as they're not too far off the track. Connie's there to pick up my slack, so thanks for being there, Connie. And Connie and I would also like to issue an invitation to everybody watching. If you have an account on X, give us a follow. It doesn't cost anything to follow Connie or me or the other presenters. It's the best place to connect with your favorite coaches in between the live streams. So you can find Connie there at Connie Hill CS. You can find me on X at Cameron May CS. But let's get into this discussion of today. We're focusing on vertical spreads. But before we can get into that, of course, we need to first of all pause to consider the risks associated with trading. Risk can be substantial. So bear these important disclosures in mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general information only, informational purposes only, and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as the sole means of investment research. Investing involves risks, including the loss of principal, and any investment decision you make in your self-directed account is solely your responsibility. All right. So with that important information covered, let's set the agenda for the day. First thing that we're going to do is take a look at existing positions. I noticed Greg had asked, hey, Cameron, can we talk about maybe adjusting the UNH position? We are going to be taking a look at that position and others. That's the one that I did want to talk about today, though, Greg. So yeah, you and I are kind of on the same wavelength there. Then we're going to look at the markets, set a quick context for entering into a new position today, and then we're going to plan and place a vertical spread with an exit order attached. Its intended purpose is to harvest profits early if they manifest. Obviously, time will tell, but should be a great discussion. Let's go right to Thinkorswim and take a look at, so this is the Thinkorswim desktop software platform. So just to be aware, in most of our webcasts, you'll see us using Thinkorswim desktop. Now, there are other versions of Thinkorswim, like Thinkorswim web, that are different. So if you're following along at home and it looks substantially different than what you're seeing here, just make sure that we're on Thinkorswim desktop. In any case, so here we are. Here are our existing positions, our long verticals and diagonals. We have 5 positions right now, starting with Amazon. Let's have a look at that. So Amazon is a vertical spread. We bought the 220 calls, sold the 225 calls. This is a bullish vertical spread, so we prefer for the stock to be above that spread. So in other words, above 225. Look where we are. We're actually right now almost exactly dead center middle of those strikes. That's kind of danger territory. Risk is always present in these sorts of trades, but we need to be aware of this. When we entered this trade, what we saw here was this uptrending stock seemed to be rising along this line of support. We thought that might be a price floor, but we've broken down below that price floor, and we've entered between our 2 strikes, the 220 here and the 225 there. If you're wondering where all these illustrations came from on my chart, I just drew them on. You can go back and look at previous archives to see where those were created. But yeah, I just draw these in. It's not anything that just shows up automatically on a chart. But in any case, when we're right between our two strikes, remember we bought the 220, sold the 225. That 225, those 225 calls are now in the money. That means there's an elevated risk of early assignment on those in the money contracts. There's always a risk of early assignment. Okay. Now, pardon me. I'm sorry. I get a little bit. Sometimes I can get ahead of myself. Now, the long calls. Actually, what we're looking for here is assignment. The long calls are in the money. The short calls are out of the money. So we've reduced that risk. So just forget what I said. Sometimes I get a little bit ahead of myself in my enthusiasm to explain a concept. But what this can expose us to, if we're in this same position, if we're still between our two strikes and we allow this to get to expiration, the long call is automatically assigned on our behalf, and we may wind up buying shares that we didn't intend to. Okay. But for right now, what we're going to do, I think for this position, we're going to see if we can get a little bit of a recovery just after a retracement here. If it continues to sell, losses may continue to mount on this position, but I'm going to let it continue to work. So this one we're not going to make a change to, nor are we going to make any changes as a spoiler alert to our Broadcom, our Gilead, or our Microsoft positions. But with Broadcom, well, this is another long call vertical spread, 220, 225. In this case, look at this, also sagging just below the short. So another one that we'll want to keep an eye on. There we go. And especially look at this. This one is 1 day from expiration. So instead, I wasn't planning to exit this. I thought it would be interesting to see if it could hold up here where it started this morning. Not holding at the moment, and we don't have the luxury of sort of waiting around to see what happens. If I let this go, I don't make changes to this portfolio in between the webcasts. So if this were, if the short were out of the money at expiration and the long is in the money, that would be assigned. In paper money, assignment or exercised, exercise only happens at expiration. Assignment only happens at expiration. So that's different from real life. I'm going to close this one out, though. I wasn't planning to, but there's only 1 day left. This one did go underwater on us. This one was profitable until essentially just now. You'll notice $434 underwater today, but that includes a $1,400 reversal of fortune just today. That's how quickly, when we're right close to our strikes, if we're also close to expiration, things can flip very quickly. But with this one, yeah, I think we're just going to have to take some lumps on 11 contracts. Could have been far worse, but time to exit. I'm going to right click here. Let's create a closing order to sell these verticals. Looks like we're trading between 277, 291. We might be able to get out. Let's see if we can get 285 out of this. Okay. Requiring 285. That's still actually asking a fairly generous credit. We'll see if we can get a fill. You can see the prices are fluctuating. Markets are open. Let's confirm and send this order. Attempting to sell, I have to say that because with limit orders, there's no guarantee of a fill, but attempting to sell those 11 contracts for 285. Max profit, max loss, this would be if we were entering into a brand new or opening a new trade. This is to close, so we don't worry about this. But we do want to bear in mind there are commissions to be paid here. Let's send this order off and see if we can get an exit here. We would be realizing here about a $400-ish loss. All right, so we were saying we were willing to sell for 285. We closed out at 307. So that actually wasn't a terrible exit. If you look at the, well, actually, I'll forget that. It was just a kind of a generous exit when we're willing to accept 285, 307, great. Let's see, Robert says, maybe just buy the short strike. Well, Robert, so we could, if we closed out that short strike and left on the long, what would be the issue there? We'd come back to talk next week as the proud new owners of 1,100 shares, very likely. Now, if it happened to drop If the stock continued to drop and we went below that long strike, we could have just lost the investment in that call. But if the stock was still above the longs, all in the money options are automatically assigned on the behalf of the owners at expiration. That sort of decision is removed from their discretion, and unless they left a do not exercise order, and that is pretty uncommon. Can be done, but in any case, yeah, in the money contracts are automatically exercised. So we would then own 1,100 shares of stock at $220 per share. Okay. 100 shares is $22,000. Is that going to be a pricey position? Yep. So yeah, we closed that out. Let's have a look at Gilead. Gilead is a long call diagonal. So this one, we bought the 95 calls for 2027. Own 3 of those contracts. We sold the 105 calls for March of 2025. So with this, our preference is for the stock to go up, which is helping out those long calls, but hopefully to stay below 105. It's gone up, helping out the long calls. You can see the long calls are doing very well. We're up about $10 per share on 300 shares. So up about $3,000 on the long calls. But the short calls are also growing in value, and we had a preference for those to shrink in value. So we're underwater about $733 on those. Here's what it looks like on our chart. Here's our short call. We've kind of blasted up through that. So that short call is sort of putting a drag on the unrealized profits on the long. Still net, this is a profitable position. With that short call in the money, though, that also does elevate the risk of early assignment. I'm going to let this continue to run. Still 29 days. If we can pull back down below 105, that could relieve us of some of that pressure of early assignment risk. Even now, the money option can be assigned, just not on paper money. In real money, it can be. So I'm going to let that one continue to work. It's profitable. I did want to look at Microsoft as well right now. A small profit. With this, we have a long call diagonals, a long call vertical spread. Bought the 395s, sold the 400s. Here we'd prefer to be above 400, and we're at 419-ish. So that's doing just what we might hope. Although, if we look at the chart, from the time we entered, there was a period where this was misbehaving. We're hoping to be up here in this green area. Here are our strikes down here at 400 and 395. So we'd like to just be above that as we approach this expiration out there in March. Started heading in the wrong direction, but a pretty good recovery over the last 48 hours. So that's also cooperating now. So we're going to let that continue to work. Now, finally, we have United Health. And Greg asked, can we talk about managing this United Health position? Yeah, with this, we bought a 520 call, bullish bias. We sold a 550 call, bearish bias. We'd like to go up above 520 as far as possible while staying below 550. Well, we're staying below 550, but not rising above 520. Right now, the stock's at 505. So our 550 position is making money. Our 520 long call is losing not just a little bit of money, but quite a bit of money. Let's look at that. So here's UNH, not YNH. Let's do the correct symbol. UNH. So right here is when we initially bought our 520 long call. That was back here on the, it was actually on the 9th. That was not a trading day, but paper money said, forget it, Cam, we're going to give it to you anyway. Yeah, it was a holiday. We were still talking about, it was a market holiday anyway. The stock took off, helping out our long call initially, but recently it's kind of broken down. So long call not doing so well. Well, at that time, we also sold a 560 short call. You'll notice I have a line stretching from the 9th over to the 13th of February. This short call, we actually closed out at an $8.60 profit. If we go to the monitor tab, we can look at our account statement. And here's that short call right here. Sold the 21st of February, 560 call for 955. We then bought that to close for just 95 cents. So we realized an $86 or $8.60 gain on that. That's not reflected. When we look at this and we say, oh, geez, our current positions, one is underwater, the other one is making money. The 560 call, a short call that we've already entered and exited, is not reflected. These are current open positions. So the nice thing about that is that we're sitting on, about a $680 unrealized gain, plus an $860 realized gain. So that's about $1,500 that we have made on the short options that we've sold against a $2,000 loss. So yeah, we're underwater, just not nearly as much as it might appear to be on the surface. Okay, so what should we do from here? What do we think? Our long call kind of getting punished, but look at where it's kind of interesting where we've settled. Maybe I need to look at this on a longer term chart. If I go to a 3-year chart, actually, I think it's even longer term than this. You can see that's been a rising trend line for years and years and years. Now, it doesn't mean that we're guaranteed to go higher from here, but it is interesting that if we go back to that 1-year chart, we've come right down to that trend line. Now, a trader might decide, forget it, I'm abandoning the whole trade. Let's just wrap it up, finish it at maybe a $500 loss. Losses happen sometimes. Or maybe they think, well, the trend line there was our logic for entering that long call in the first place. We thought this could go up for a long time. That's why we bought one for 2 years. Yeah, Jeremy says you can go to the account statement, see the profit and loss for the gain. Yep, that's another way to see it there on that statement. True, yes. So I think what we're going to do here is retain ownership of that long call, even though it's currently misbehaving. But this 550 short call, Greg, I don't know if you were thinking about this, but this is what I'm thinking. We originally sold that for $965. It's only worth about $284. So there's a little bit of juice left in that trade, in that position. But I think what we're going to do is let's close that up, see if we can realize about $6.80, about $681 of additional gain on another short position, and then put on a new one. And this one I'm going to do a little bit differently than the last one. Last time we were actually rolled down and out. This one, let's look at maybe sticking with the 21st of March. Here's our current position right down here. You can see where it says position. That 550 is trading, around the 280-ish, 290-ish mark. Maybe we could roll that down for a larger credit to maybe 540. Maybe bring that down here. So our price is here. How about we roll this down to right about here? So yes, we're bringing the short call closer to where we are right now, but there's still some considerable distance here. But we could also maybe do that at a credit, increase the potential return for March. We'd also be realizing the gain on the 550 short call. Let's do that. I'm going to go to the trade. Actually, let's go to the monitor tab. And I'm going to right click on that 550 call. Right click, create a rolling order. What this does when we create a rolling order, this just means we're using one order ticket to close out of the short call that we're in and reopen a new short call, maybe at a different expiration, maybe a different strike, or maybe both. So let's there's our 550 to be purchased. Let's move this to still the 21st of March, but a 540 call. That'll increase our available credit by $1.60, maybe. Let's see if we can let's say we're willing to settle this for a $1.50 additional credit. Let me click confirm and send. So this is going to show as a vertical, but effectively it's out of one short into another short, hoping for a $1.50 credit. We'll see if we can get that filled. There is a commission on both sides here. $1.30. Let's send that off. Okay, and we're in for $1.57. So here's what we just did. Let's go to our chart again. So we're out of this short call. Let's right-click on that. I'm going to make that one a lightish pink as well, kind of signifying that we're done with that one. There we go, done with that one. But we're now into a short call here. Let's make that line red. So that kind of shows us where our new short call is. That shows us where it expires. All right, so now that means that we have realized 860 gain on the first short call. We've realized, what, about a 670-ish gain on the second short call. Let's see if we can get the best of both worlds over this next stretch before March. Let's see if we can get the stock to start rising again, helping out our long, but still allow this other short call to lose value. Trade and Grow says, could UNH drop further? Absolutely it could. Every day that we own this position, this net bullish position, if the stock continues to fall, that could pile loss on loss. Right now we're sitting on a relatively small loss. That could compound. Actually, the loss just shrunk by about $100 on our long call. We'll see if it can continue to do that. Yeah, that's one of the risks, definitely. All right, so yeah, Mike says, Cam, I like the way you work through the trade live. Yeah, I only make adjustments in these webcasts in these accounts during the live webcast. So you can sort of see the logic of adjustments that we might make, or the logic of where we might close out of a position. And losses do occur. Yep, hopefully there are fewer of those than gains, hopefully of smaller size as well. But yeah, they're going to happen. In any case, done with UNH. There you go, Greg. Thanks for asking about that. But it's time to put on a new trade. Before we do that, we've talked about it, sort of a process of elimination for choosing which way we're going to go with a strategy. The first thing that a trader might do as they're planning to place a new position in their portfolio is just sort of get a gauge for what they think the markets are doing. So markets have been really bullish. And so as a result, we've been placing bullish trade after bullish trade after bullish trade with an occasional bearish trade sprinkled in there. In this series, since the 1st of January, I've only placed one bearish trade. And we kind of got away with it. We actually made a nice profit. That stock took a nice dive, and we closed that one out at a profit. I try to give a balanced education here, so I feel sort of an obligation to do some bearish trading even when the markets aren't bearish, even if we just learn that maybe that's not a great idea in the end. But let's just put ourselves in the shoes of a hypothetical trader. Maybe they've had a great run with their bullish trades, but possibly they might notice, I don't know if you've noticed, the market seem to be maybe losing steam over the last few months. Notice we've kind of struggled to really push to new highs. We've gotten there, but not much higher. Gotten there, not much higher. And notice where we are right now. We're up against those previous, that rising resistance level, that sort of feeble-ish rising resistance level. And the S&P appears to be pulling back. Let's just say that our new trader has their eyes on placing a new position out here in March, and they're trying to decide, shall I be bullish? Should I be bearish? Should I be really bullish, or should I be really bearish? I have a few choices there. And maybe their conviction is markets are struggling a bit. Maybe it's going to be kind of weak as we go through the rest of the latter part of winter. And they think that we're likely to possibly head down. They're not really certain of that. But in any case, we're going to be doing a bearish trade for today. I think we got a little bit lucky with the last bearish trade we did. It was actually one of the few that went down when most stocks went up. This could be the same way, or I would guess we're probably not going to get lucky. Time will tell, though, right? But let's just say we want to put on a bearish trade, even if it's just to provide that more rounded education. So let's go pick a stock. And what I've done is I've prepared a few potential candidates, and I'd just like your input. If you'd like to help me, give me some input on which one you think we ought to build our trade around. But what qualifies a stock as a candidate for some traders when they're considering putting on something like a bearish vertical spread? Well, price can be a consideration. Higher price stocks carry larger obligations on the short positions, but they can also offer more choices in the strike selection. So there are pros and cons. Also, what the liquidity levels are for the stock can really determine whether the stock's options are liquid or not. Illiquid stocks tend to have illiquid options, and that can cause issues with pricing and tradability. It can just make it harder to trade them. A third consideration, though, is what's happening on a chart. So I've looked at some of the larger companies in the world. I'm narrowing in on maybe low triple digits for price. But let's see what's going on with the charts here. Oh, CEOS says Walmart. Well, Walmart has been going up and up and up. We're going to be doing a bearish trade. It could turn and go down. But how about we look at three stocks? Let's look first of all at McDonald's. I want to see what's going on. Here's what's happened with McDonald's. It had a price ceiling here that was broken on a strong earnings announcement. But boy, it sagged back and it slipped back down below that ceiling. Maybe that's going to act as a new ceiling going forward. So maybe a technical trader might see this as bearish through March. Time will tell. But that's a quick view of McDonald's. Let's also look at Qualcomm. Here's Qualcomm. Qualcomm's been rallying for the last couple of months, but look where that's positioned it. It's come right up to a price ceiling, which through most of this whole last year, the stock has struggled to stay above. There was one day where it closed above that level in the last 7 months or so. Okay, so maybe our trader sees this as rising up to a price ceiling, bumping its head and set to go down. So McDonald's, Qualcomm, let's also look at AMD, Advanced Micro Devices. This one's just been bearish. Lower highs and lower lows. You can see it's been running up to this downward sloping resistance line, bumping its head and then selling off over and over and over and over and over again. And look at where we are right now. So we've gotten clear of this earnings announcement that could, for some, not look great. But what do we think? McDonald's, Qualcomm, Advanced Micro Devices. What are your thoughts there? Let me see if any votes have come in. I know some of you are asking about maybe other symbols. I'm just going to stick just with these for now. What are some other considerations here? Well, with each of these, they should have a relatively narrow spread between the bid and the ask price. That's partly due to the liquidity, maybe even largely due to the liquidity. But boy, quickly, looks like a bunch of votes for AMD. All right, but yeah, keeping an eye on those spreads. Well, let's go ahead and build a trade around AMD then. Yeah, Alexis, AJ, Ahiskell, Dan, Stan, David, RG, Melissa, Pat, a lot of votes for AMD. So I'm going to go build a trade around AMD. Maybe what we can look to do, where's this resistance right now? It looks like it's around 115. Let me draw in a line right at about 115 so you can see what I'm talking about. It's right around there. I think that was actually 114 and change. But you'll notice we're bumping our heads right there. Let's see if we can structure a trade that as long as we're below 115, the trade's in good position to make money. So we're going to go to AMD's option chain. Let's go to the 21st of March. And let's look at the 115, maybe 120, possibly even go higher. Could we get away with 120 and 125? How about we look at that? We're going to structure our trade. So as long as the stock is below here, here's 120. Carry that out to expiration. And then 125 is going to be right up here-ish. There we go. How about we build our trade right there? So we just like to be below those levels, below 120, more precisely, as we approach expiration. So here's our trade, 120, 125. A quick way to place that trade is to go to spread single and change that to vertical. And then we can just go to that strike pair, 120 and 125, and click on the ask price. Looks like it's going to cost us a little bit under $4. So on a $5 wide spread, that might leave us, if we're spending $3.80-ish to get into a $5 wide spread, that leaves about $1.20 in potential reward. So here's our example trade. Let's outline this. Let's do two things here. First thing I'm going to do is bold this all, and then let's make this uppercase just so you can see it a little bit more clearly. We're going to do a long put spread. Okay, and the details are we're going to buy the 120 puts and then sell, buy the 125 puts, sell the 120 puts. Yeah, Alexis, we're doing a put spread. Trader says, wasn't NVIDIA the last bearish trade you did? That was probably in a different webcast series, so I don't review those in this one. I think that one was one that we did for my Tuesday webcast. Yeah. In any case, what the objective here for the trade is, if someone has the right to sell shares to us for 120 and the shares are worth less than that, look at the shares are only worth 114 right now. As we get to expiration, there's a high motivation to assign that contract. Sell us the shares at 120. Well, at that point, we just sell the shares to someone else according to our contractual right. We have the right to sell shares at 125, buy shares at 120, sell shares at 125. That leaves us with a theoretical, let's do the math this way. The theoretical max gain of this trade would be $5. If we buy shares at 120 and sell at 125, awesome. Except it did cost us, let's say that we're able to get this done for, maybe we might have to spend, I don't know, let's go ahead and say that we have to spend $4 to do this. If we have to spend $4 to set this trade up, then that leaves us with $1 that can be made. What's the theoretical max loss? Well, if we spend the $4 and both contracts just expire worthless, oops, that's not what we wanted. We just lose the $4. So there's $1 that might be made. There's $4 that might be lost. Yes, there's more that can be lost than can be made on these sorts of trades because of their high probability of success. CSS Cameron, is this in the money a synthetic put vertical? Nope, there's no synthetic isn't part of this. Synthetic usually refers to like a synthetic version of stock ownership. That's not what this is. It's just a plain old vertical spread. It's a long put vertical spread. It's called long because it's costing us money. It's a debit. So when we buy something in the investing or trading world, we say that we're long that thing. It's called a put spread because we're constructing it using puts. It's called a spread because there's a spread between $125 and $120, a $5 wide spread. And 125 is higher than 120, so it's a vertical spread. There we go. Carlos was like, oh my goodness, I can lose $4 and make one. That's a 1 to 4 reward to risk. That's crazy. Well, that's in the eye of the beholder. Which is the most likely outcome, that we make $1 or that we lose $4? What do we have to do to make $1? Well, the stock just needs to be below 120 as we approach expiration. That puts us in position for a maximum theoretical gain. We want to be down here as we move toward the 21st of March. Well, the stock's already down there. Doesn't even have to do anything. It can go down or sideways or just not go up too much, and we're in good shape. Here's where we don't want to be, and this is where we would be exposed to the $4 loss. Let me make that one red. There we go. Yeah, if the stock were to finally rally after all these months and get up here to 125, here's what would happen. Let's talk through this. If someone has the right, let's say the stock goes up here. Let's say it blasts off. It goes up here to 130 at expiration, just above 125. If someone has the right to sell shares to us for 120, but those shares are worth 130, are they going to do it? No. Maybe somebody gets a wild hair and they decide to anyway, because they can if they want to. It's just that there's very little motivation to do that. So they say, Cameron, forget it. And they walk away. Their contracts expire worthless. Well, we also have the right to sell shares to somebody else for 125. Are we going to do it? No, the shares are worth 130. So that expires worthless. All of this whole investment just expires worthless. So that's a $4 loss. Yep. So that's just not as likely an outcome. Still possible. It's just not as likely as just being down below 120. Matter of fact, we can check those probabilities. We can just go to our option chain. Let's set this back to single. And what I'm going to look at, we have the 125 and the 120. I need to go back up a little bit. There we go. There is a 66% chance. Now, delta can be used to gauge leverage on an option. It can tell you how much it might make or lose on a $1 move. It also might show us an approximate likelihood that a contract is in the money at expiration. 66% chance of in the money. That leaves only a 34% chance that we're out of the money. And hopefully, maybe the trader has done themselves, maybe they've tilted the scales a little bit more with some technical analysis. That's not guaranteed. But yeah, this is just not likely to happen. Could, and we're going to talk about managing that in later weeks. But what I want to focus on here for this discussion is this. This is a high probability outcome. As a matter of fact, right now, at about 79% probability, if we were to just put this trade on and let it go, that we're at maximum gain as we approach expiration in that maximum theoretical gain territory. Well, for some traders, that's great. They might hold on for the full dollar. For others, though, they recognize that sometimes the stock is quite cooperative. Let me maybe zoom in a little bit. Let's switch this to, let's say, a 6-month chart, so we can get a closer view. And sometimes the stock does just what we think it's going to do, and it shoots down, in this case, in the direction intended. How many of you, let me ask the attendees here who have traded vertical spreads before, either paper or real life, doesn't really matter. But how many of you have gotten into a trade thinking, oh, so I could make $1 in 29 days, and then 3 or 4 or 5 days later, we're already sitting on an 80-cent profit or a 70-cent profit. The stock is going just where we would hope. It's just doing it faster than we thought. And so now we're looking at, I could just get out right now. Yeah. And have most of that planned gain. Let's say that our trader thinks it's great that it has $1 of potential profit, but they'd actually be satisfied with, let's say, at least 80% of that anytime before expiration, whether it's a couple of days into the trade or maybe even 20 days, 30 or 25 days into the trade. Yeah. All right. A lot of you say, yeah, Mike, you've done that. Soraka says yes. Greg, yep. Jeremy, Cola, yeah. So here's the thing. Do we know if that scenario plays out, do we know when that might happen between now and expiration, even if it does? Nope, it might be in a few days. It might be in a few weeks from now. So, but what a trader can do is just place an order to get out at any point if they're able to exit with at least, whatever percent amount they want. Some might say 50% of that maximum gain. Some might say 80% of the maximum gain. That can that can vary from one trader to the next. But let's just say that our trader wants at least 80%. 80% of a dollar is going to be 80 cents. Here's how we might do that. If we buy for $4 to get into this trade, how much would we need to sell for to take an 80-cent gain out of the trade? Well, we need to sell for at least $4.80. So at the same time I'm entering this order to buy in for $4, and it might not even cost me $4. Looks like it might be costing us about $3.90 at this point. Oh well, I'm going to leave it at $4 just to keep the math simple. In any case, I'm going to change my advanced order type here. Let's close up this left column for a moment. Let's change this from a single order to first order triggers a sequential order. That's what this means. If we're able to get this first order filled, it'll put a sequential or a second order into effect. And I'm just going to come up here now and right click on our first order and create an opposite order. This one is to take the profits if profits occur. So if we're in for $4, let's see if we can get out for $4.80. I'm going to make that order good till canceled, leaving it as a limit order. Limit order just means this is the least I'm willing to sell for. That's my limit, not a penny less, $4.80. Yeah, that would be taking our 80-cent gain, and we're done. So yes, this thing can sort of be, this can be automated in advance. Now, interestingly, this is getting less and less expensive to get into this. Should we see if we can do the math on this? What if it only cost us $3.80 to get into this trade? Ooh, what would be the price we would enter here to get out for 80%? Well, if we're into a $5 wide spread for $3.80, that leaves $1.20 of reward potential. 80% of $1.20 is going to be what, 96 cents? I just did that math kind of quickly in my head. So 96 cents above our 380 investment is going to be what, 476? No, yeah, 476. Did I do that right? Let's check my math. $1.20 maximum gain times 80% is 96 cents. Add that to our 380, 476. Yep. There we go. So can we still possibly get in for 380? Might be a little bit generous. Let's see. Let's click confirm and send. Going to look to buy this vertical. And by the way, this is also where we can check to see how much we're willing to risk. 380 on one contract is $380 of risk. We typically risk about $4,000. So let's go ahead and do 10 contracts on both sides and click confirm and send. Buying 10 of these verticals, the 120, 125. We're going to look to sell those at a 96-cent profit or 80% of $1.20. There are commissions on either side of these to get in or get out. Let's send this order off. Let it work. Okay. So there's our trade. I might have to keep an eye on, oh, look at that. We got filled at 380. Nice. Okay. So now we have our working exit order. But guys, we've accomplished what I set out to do today. That was quite a bit. If you need to go back and watch the archive for this, it might be beneficial for those that are kind of new to vertical spreads. But we've talked through the management of existing positions, including that UNH position. We looked at market conditions and sort of set the stage for a counter trend bearish trade. We'll see if we have a little bit of luck with this one. But we also, as we placed that trade, entered an order to get us out with 90%, well, pardon me, with 80% of our original maximum profit on the trade. Time is going to tell how this thing works out. We need to keep an eye on the short strike, keep an eye on the long strike. As we get close to expiration, make sure that we're not exposed to, let's say, getting exercised on our long when our short's still out of money. That could leave us just in the position of selling some puts that we didn't intend, or selling some shares that we didn't intend to. All right, everybody. thanks for giving me your time today. We'll take a look at this trade and the rest in future weeks. But as I let you go, just remember, if you haven't done this already, go down and click on the subscribe button. That'll subscribe you to our Trader Talks YouTube channel. And this is where we host our webcasts, our previously recorded webcasts, as playlists. You can also join our live streams here. It doesn't cost anything. Go down and click on the subscribe button. It only takes a second. But also make sure that you're following Connie and me on X. That's the best place to connect with your favorite presenters in between the live streams. So you can find Connie on X at Connie Hill CS. You can find me there at Cameron May CS. Thank you, everybody. I see CS says smash the like button. Yeah, I can see that already 56 people have clicked that like button. That's very much appreciated. That feels like applause to your presenters. And it also gives us a boost in the YouTube algorithm, helps more people find our webcasts. We just can help more people understand these sorts of concepts. All right, but everybody, I will see you maybe next Thursday. I have something else every day of the week if you want to join me in my other webcast series. I'd love to see you there. I'll also look for you on X, but whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.